Hey everybody, it's Joey from Universal CPA Review. Some of you might know me as Ask Joey. If you're studying for the CPA exams and you consider yourself to be more of a visual learner, you've come to the right place. So don't forget to subscribe to our YouTube channel, join our Facebook study groups, and our Reddit community. You can find the links to those in the description below.
Okay, boom. We're moving right along throughout this audit engagement. The audit team has now officially accepted the engagement. We have agreed to the terms of the engagement, and we have signed off on the engagement letter. So now we are ready to dive right into it. So one of the first steps in the audit engagement, and an area that is very, very testable on the exam, is the concept of risk assessment. So the two primary buzzwords associated with risk on the exam consist of audit risk and fraud risk. Okay, and at the end of the day, we need to understand the concept of risk and how it ties into the performance of this audit engagement. Right? At the end of the day, we're providing assurance to the financial statement readers. We are assuring them that the client that we're auditing has presented the financial statements in a manner that is in accordance with the applicable financial reporting framework and is free from material misstatements, whether due to error or fraud. Okay, but before we just start obtaining audit evidence, right, before we just dive into it like a bunch of wild animals, Detective Lucy and her crew are going to first do this assessment of the client's overall risk. So what might they be at risk for? Well, this is where the AICPA literature differentiates both audit risk and fraud risk. Okay, so we're going to start by talking about audit risk. And within audit risk, we have this framework that is displayed as the audit risk model. Okay, so audit risk equals inherent risk times control risk times detection risk. Okay, so I know you're either sitting there at your computer screen thinking this looks like a bunch of words, or you're sitting there aggressively writing this formula down. Right? You might be thinking, if I just memorize this formula, I'm going to get these questions right. And then you remember, wait, this is not a mathematical exam. It's a conceptual exam. So this is going to require that we take a step back. I want you to save the ink in your pen, and I want you to just think about the logic here, right? Thinking about this little formula, at the end of the day, the name of the game is determining the overall audit risk. And in layman terms, we are trying to assess the risk that the auditor is wrong. And even more specifically, this is the risk that the auditor issues an incorrect clean opinion when a material misstatement actually does exist. Right, as an auditor, this is worst case scenario. Our whole job is to provide assurance that we have evidence that the financial statements are accurately presented and are free from material misstatements, regardless of whether that's due to error or fraud. Okay, we can even not have an answer, right? We might not have obtained sufficient appropriate audit evidence to come to this conclusion. Okay, for Detective Lucy, she might say, look guys, we were unable to come to a conclusion. We're going to issue a disclaimer of opinion. We're going to issue a qualified opinion. But if Detective Lucy says we're going to issue this unmodified or unqualified opinion, right, this clean opinion, when in fact this is an adverse opinion due to something that they missed, well, then that's going to be a problem. And that is ultimately the audit risk. Okay, so let's dive into the details and let's identify what it is we need to know for the exam. As we mentioned, this audit risk model is this little formula, but it's a conceptual formula. And if we give it our time and we interpret it correctly, this is going to be super easy points on the exam, all right? I'm telling you. So let's start by breaking this down. We know at this point what audit risk is. It's, again, the risk that we're going to issue the wrong clean opinion. Fine. But what I want you to focus on within this model is the fact that we have the overall risk of material misstatements, which will dictate our detection risk. And I want to drill these down even further. So I want you to take risk of material misstatements, and I want to break this out into inherent risk times control risk. And when combined, these make up the overall risk of material misstatements. So when thinking about inherent risk and control risk, I want you to write down the word assessed. Okay, so this is going to be assessed by the auditor. And then, even more importantly, above the words detection risk, I want to always insert the words acceptable level. Okay, so you should always associate detection risk as the amount that the auditor is willing to accept. Okay, and I want you to consider detection risk as controlled by the auditor. So let's first zero in on inherent risk and control risk, right? Our risk of material misstatements. So inherent risk and control risk, again, are assessed by the auditor. These two elements are completely out of Detective Lucy's control. So on the exam, inherent risk times control risk is going to be synonymous with risk of material misstatements. And again, paramount to understand that we, the auditor, are going to be assessing this overall risk of material misstatements, right? So the risk of material misstatements isn't always going to just be flat out visible and easy to point out by the auditor. So we're going to need to do some assessing and use some professional judgment. Okay, so how are we going to assess these words if we don't know what they mean? Okay, so let's start by defining what these words actually mean: inherent risk and control risk. Okay, so the formula for calculating the risk of material misstatements, inherent risk times control risk, is important to note that both inherent risk and control risk will exist independently of the audit engagement. Okay, so that definition has been asked on the exam. We need to know that both of these are going to exist independently. And all that means is that both of these risks are out of the control of the auditor. Right? So these risks can't just be alleviated by the auditor doing more work. So let's assume here for a second that Detective Lucy is auditing Lewis's laundromat. So this is one of the companies that she's staffed on, and for whatever reason, her firm accepted the job. But the reality is, right out of the gate, this has shady stuff written all over it. So why is it so shady? Well, for one, all of the transactions are paid directly to the manager, Lewis, in cash. And not to mention, when Detective Lucy showed up to meet Lewis to introduce herself as the auditor, Lewis was totally hammered drunk at the meeting. Okay, so immediately, Detective Lucy has assessed and determined the following things. Inherent risk is high, control risk is high, and the overall acceptable level of detection risk is low. So let's think about each of these. What is inherent risk, and why is it high in this case? So I know that this is an extreme example, but let's think about this logically. By definition, inherent risk is the susceptibility that an assertion made by management will result in a material misstatement, assuming no internal controls exist. Okay, so this is something that is inherent to the company. So read this a few times, and I want you to take a step back and think about our buzzwords. So as you notice, this definition does include the words internal controls. That has thrown candidates off in the past. They might see assuming no internal controls exist and think, wow, that must mean control risk. All right, I get it. But when you see assuming no internal controls exist in a multiple choice question, you're thinking inherent risk. Okay, so take a look at this little man and think about the complicated transactions that are going to be in his head. And I want you to use this as a memory aid, because inherent risk is typically going to be things like complicated calculations, high volume transactions, cash businesses, the amounts derived from estimates made by management. Okay, so ultimately these are risks that are out of our control as the auditor. It's even out of management's control, but it doesn't mean that they don't exist. In the case of Lewis, he is accepting tons of cash transactions, right? That means maybe there isn't a huge paper trail. So it makes it harder for Detective Lucy to grab that information. Ultimately, the auditor will assess inherent risk as high if the financial statements are likely to contain material misstatements, and they are assessed as low if the financial statements are likely to not contain material misstatements. So the second risk that we are assessing is control risk. Okay, so control risk is the risk that material misstatements could occur in a relevant assertion and will not be prevented or detected on a timely basis by the company's internal controls. Okay, so take a step back and let's think about the buzzwords there. Also includes the words internal controls. When thinking about inherent risk, our buzzwords were assuming that no internal controls exist. But when you're thinking about control risk, our buzzwords are going to be will not be prevented or detected on a timely basis by the company's internal controls. Okay, so we noticed Lewis, right? We noticed that Lewis is pissed drunk at work, and not to mention he is the one accepting and recording all of these cash transactions. Okay, so I don't care that Lewis is a highly functioning alcoholic. Error is likely to occur in our eyes. Okay, so there is no segregation of duties, and Lewis is drunk. So by definition, control risk will be considered high if the controls implemented are not operating effectively if there are no controls that exist related to a specific assertion, or testing operating effectiveness of internal controls is not efficient at all. Okay, so Lewis represents an overall poor system of internal controls, right? And again, this is the client's risk that we are assessing. Okay, so we're just looking at this laundromat and we're saying, whoa, there's no segregation of duties, the manager's drunk. Because of the internal controls set in place, what are the chances that material misstatements will not be prevented or detected on a timely basis by this internal control system? Probably high. Okay, so as auditors, it's not our responsibility to design and implement or maintain our client's internal controls. It's not our fault that Lewis is drunk. This is just what we've assessed. So the question becomes, what are we going to do about it? Well, based on our overall assessment of risk of material misstatements, we're going to let this dictate how much detection risk we're willing to accept. So this is what we, the auditor, ultimately control. So essentially, we're letting this guide us on whether or not we need to do more work or less work based on this assessment. So throughout this process, the auditor is going to be performing these risk assessment procedures, and they're going to be testing internal controls. Okay, so by definition, detection risk is the risk that the auditor will not detect a material misstatement within a relevant assertion. Right, so unlike inherent risk and control risk, detection risk is not going to exist independently of the audit. Okay, this is within our control. So therefore, the assessed level of detection risk is going to be based on the amount of work that the auditor will need to do thereafter. So what are some examples of detection risk responses? Well, if risk of material misstatements is high, then Detective Lucy is going to be willing to accept less risk, right? She's getting a little bit sketched out by Lewis and how much cash is coming in. She's a little freaked out by the fact that he's been drinking. And the type of work that she can perform might consist of test of details and substantive analytical procedures. Okay, so if those are foreign words, just hang with me. We're going to dive into that in just a little bit. Don't you worry. Okay, so beyond the audit risk formula and defining each of the elements within the formula, what the sickos at the AICPA can ask are questions related to the overall relationships with audit risk. So we have two relationships to consider here. We have risk of material misstatements and its relationship with detection risk, which we remember is the overall acceptable level of detection risk. We also have the relationship between audit risk and materiality. So what's super important to keep in mind is that both of these relationships will be inverse relationships. Okay, so let's start by focusing on this first inverse relationship between the risk of material misstatements and detection risk. Okay, so let's start here. And let's think about this for a second, because on the surface, it might not seem so easy to see. So at this point, we understand the audit risk model at a high level. We understand that the risk of material misstatements will be broken out into both inherent risk and control risk factors, which ultimately is assessed by the auditor, and that impacts the overall acceptable level of detection risk. And if there's one thing to take away from this entire module, I want you to remember the words acceptable level. Okay, because this is going to be huge for understanding these inverse relationships. Okay, we must remember that we're talking about the acceptable level of detection risk, because this is going to impact how the auditor will respond. Okay, so without the words acceptable level, you might take a look at this and think, wait a minute, inherent risk and control risk is high. Why the inverse relationship? Why would detection risk be low? But if we insert the words acceptable level, all of a sudden this is going to make sense. Okay, so I don't care if you're at the Prometric Center and the first thing you do when you get there is write out this formula and write out the words acceptable level in front of detection risk. Right, if control risk or inherent risk is high, that means that we're willing to accept less risk, which means we're going to do more work. Okay, so without the words acceptable level, this sounds like if inherent risk and control risk are high, detection risk is low. Right, detection risk isn't low. The amount that we're willing to accept is lower. Okay, so this is just a funky way of saying detection risk is actually high. All right, but I don't want to confuse you because they do like to ask about this inverse relationship. Okay, so if the company has high volume transactions or cash transactions, large amounts of estimates, if they have complex transactions or the economy is sort of weird, that means inherent risk is going to be high. Right, a bunch of transactions or complex derivatives thrown into the mix of the client that we're auditing is going to make this more challenging for us, which increases the risk that we're going to come to the wrong conclusion. That, at the highest of levels, is what we're worried about.
And same goes for control risk, right? If internal controls are designed ineffectively, or they are not operating effectively, or if they do not exist for a specific assertion, or testing them is just not efficient altogether, that means that the internal control factors will lead to an increased level of risk that we're going to come to the wrong conclusion. Okay, so we don't want to get this wrong. Okay, so as the risk of material misstatements go up, the acceptable level of detection risk goes down. And that, my friends, is the inverse relationship that we're referring to. But what happens if the acceptable level of detection risk goes down? Well, that means we're going to do more testing. So this is when things like more confirmations go out the door. When we perform more tests such as footing or recalculation, if we do more inspection, tracing, vouching, further observation of the client's operation. These are examples of the work that is going to be conducted to a larger extent if we've assessed that risk of material misstatements is high. Okay, so that's inverse relationship number one. The other inverse relationship that we need to consider is going to be the inverse relationship between audit risk and materiality. Okay, but again, we're going to focus on the words acceptable level. Only now we're thinking about the acceptable level of audit risk. Again, audit risk is the risk that we're going to come to the wrong conclusion. So let's think about how materiality impacts our audit risk. Okay, so think of materiality as our driver. If we have an increased level of materiality, that means that if we get it wrong, then it's likely that the misstatements are going to be material. Okay, so if cash represents 80% of the client's current assets, then yeah, that's pretty material, I would say. So we probably don't want to mess this up. So that means we're going to have a lower acceptable level of audit risk. Okay, as you can see, inverse relationship. If cash is only $15, well then that means we don't really care as much about making a mistake related to cash. So we're going to have a higher acceptable level of audit risk. Okay, so know your relationships, know how this works. At the end of the day, understanding this audit risk model and the definitions between inherent risk, control risk, how it impacts the acceptable level of detection risk, that is ultimately what you need to know.